Sam Stovall, Chief Investment Strategist at CFRA. You have conducted extensive research on the history of market bubbles. Can you share key findings from that research?
Sure, Chris. Well, what I have found is that while bubbles might look pretty evident when examined with a rear view mirror, when they're actually occurring, I think a lot of investors think that they're not in a bubble, or at least they can rationalize why it might not be in a bubble. Today, a lot of investors are of the mindset that we are in a bubble when they point to valuations or the price to earnings ratio for the S&P 500, when they point to the market cap on the 500 versus GDP, et cetera. But at the same time, investors have been wondering how come we haven't had a recession? Because many of the prior indicators, such as an inverted yield curve, a year-on-year percent decline in leading economic indicators, which usually do point to recessions, just have not materialized. So I guess that's what John Maynard Keynes once said: markets can remain irrational longer than short sellers can remain solvent.
With that in mind, how might investors assess the current market landscape?
Well, I think the real question is when you make a comparison with history, how far back should you go? Because if you're looking at the past 20 years, right now the S&P 500 is trading more than two standard deviations above the mean. For those people who got a C minus in math, let's just say that it's a more than 40% premium to the average over the last 20 years. And tech is trading at a 63% premium over the last 20 years. Some would say, well, you really don't want to be going back 20 years because AI has been driving tech for only the last 5 years. So in that case, maybe we see a pullback, a 5 to 10% decline. Maybe we see a correction, a decline of 10 to 20%, but probably not a major bear market because, in a sense, we are making comparisons to a situation that is not present today. And I think it's that kind of justification that could end up causing problems for investors. And as a result, they might not be sure that they are in a bubble environment or are convincing them so that they are not. So, with that in mind, I would say for investors, you don't want to try to time the market because rarely has anybody been successful over a long haul trying to do that. I know myself, anytime I try to jump the gun, I only end up shooting myself in the foot. So, with that, I say stick to your long-term investment plan, but focus on quality. Go for those companies that have a track record of raising their earnings and dividends. Go for those companies that are trading at a discount, that are typically offering a higher dividend yield than they normally do, but at the same time have a payout ratio that's maybe 80% or lower, because then that way they are not likely to experience the same kind of setback that these high flying, high PE stocks might be should we get that pullback correction or even a bear market.
Sam, excellent insights. Thank you very much for your time.
My pleasure, Chris.